a book of Vix Perandeo. I don't know if he was an option trader, and basically he made a lot of money trading option because he was really good at distinguishing these two factors. Okay, you become very good at option trading specifically, and now even futures trading, when you can really say if that option is rising in price because of macroeconomic variables or because of specific factors. But obviously what you said is absolutely true. This is mainly a theoretical approach to this, but to a trader which is in the city probably doesn't even know these things. Okay. So I was saying log normal returns. The log normally distribution of data allows for a more accurate estimation of the return sensitivity for a given change in the information set available in the market for any given time. It means what? Any guess? You look crossed again. It means that, have you ever tried to draw a moving average? When you do that, have you ever noticed the difference between an exponential moving average and a normal moving average? Exponential moving average is much more sensitive. It's much closer to the real price action. That's why we use log normal returns. It's exactly the same theory. It doesn't change. Is exactly the same. Log normal returns make the returns more sensitive to the real price action, so it's much closer to what is really happening in the market. This is the formula, don't worry, it's very easy. PT stands for the price. Today's what, Wednesday? Okay. Tuesday. Let's assume that we are trading again Google shares. Okay, this is the closing price of yesterday Google shares, the closing one, and this is the closing price of Google shares today. You divide them, you take the logarithm of it. You don't need to be a mathematician to do that. Just plot in Excel spreadsheet. Just type equals ln. Open a bracket, put this calculation, close the bracket, you press enter, you've got a calculation. You don't need to be a mathematician, you don't need to know what a logarithm is. We're talking about a natural logarithm because it's more sensitive. I prefer that to a normal logarithm. But anyway, it's up to you if you want to do that. It's very easy. That's the way in which log normal returns are calculated. So once again, yesterday's closing price of whichever asset you're trading, today's closing price, you take the logarithm of it. You can even use a normal calculator. We'll do that for you in a second, and then you've got the returns for that day. Why we use returns rather than prices? Because it normalizes all different prices. Absolutely true. They normalize all the price. They are much closer to what really happens in the market, okay, to the real price action, and we will go through that later on. Even though I have to apologize, we experienced some IT issues, so probably there will be a chart that I plotted that is not going to come up. Stochastic volatility. I introduce you now the Garch model. Garch is an acronym for Generalized Autoaggressive Conditional Heteroscedasticity. It's a very posh term to say at random. Okay, academic loves that. Okay, so that's an autoaggressive process. Basically calculates the correlation between yesterday's closing price and today's closing price. In other words, it's a number which says, which tells me if yesterday's value is linked somehow to today's observation. That's an autoaggressive process. Heteroscedasticity means, are returns following a long average mean, or they just spread out in, like this? If they follow a long average mean, it means if there is a long average volatility going on in the market, if the correlation is very strong, volatility is going to fluctuate within certain boundaries. In that case, we're going to talk about homoscedastic returns. When returns are spread out It means it's not possible to detect a very good best fit line, like a regression, for instance. In this case, we have to talk about heteroscedasticity. Particularly, I'm referring to residuals, for those who are familiar with statistics on econometrics. Alright, the gauge variance is just another way for another term for volatility, okay? So don't get scared. It's a weighted average of three different variables. The first one is the long run average volatility. We talked about that later. Before. Forecasted volatility values calculated in previous period, new information not available when the previous forecast was made. This is how the model works. Okay, that's what it do. It takes the long run average volatility for a particular market. When you run the model on a particular market, it forecasts the volatility the day before. Okay, let's see an example. We are running the model now. We are on Tuesday. We run the model. What the model does, it takes into account the long run average volatility. It forecasts the volatility of yesterday. How it does it, like how would have been the volatility running this model, trying to forecast the volatility backward. It's a backward forecasting, okay? So it forecasts the volatility yesterday and it adds the new information available with today's observation. That's what it does. It's a weighted average because these are numbers, okay? Don't get scared. Nothing. These are numbers. This is a number. It's usually 1% when we talk about long run average volatility. This is not a number. This is not a number. So what they do, they take a weighted average. This number weight for roughly the 30%. So it's, for instance, 40. They take the 40% of 40. This is about 60%. Sorry, 30%, 60%, 10%. Okay, then you sum up those numbers, and you have got the volatility measure for that day. That's how this model works. I didn't put any formula because otherwise it would be too complicated, because they're like this almost. So if you want to just email me, I can forward you 700 pages dissertation if you like. Alright, those are calculations that I perform myself using stochastic volatilities, and particularly the exponential generalized autoregressive conditional heteroscedasticity model. It's an asymmetric model. It tells me if there is leverage effect or not. It's very useful to say those are percentage points, okay? It's expressed in decimal. This is 1%, 2%, 3, 4, 5, 6, 7%, okay? So this is how the volatility works. And this is the period during the crisis. Do you remember how the volatility was during the crisis when you were reading Financial Times? They were saying about how much? Measure, percentage point, 70%, 80%, 85%. This is the true volatility. Happens specifically in the crude oil futures market. When you use the VIX, you gotta be careful. It overestimates a lot the volatility, because remember, the volatility index is calculated on option prices on the Standard & Poor's 500, which is a very volatile market. So even though we experience volatility in the crude oil futures market, the volatility was not as high as in the Standard & Poor's 500. So when you look at the VIX, it's a good way to say, okay, volatility is rising or decreasing, but be careful when they tell you it's about 70% or 80%, because it overestimates a lot. If you are interested in this, I can give you more than 25 or 30 academic articles talking about that. There will be another PowerPoint presentation which I will try to recalculate the VIX using stochastic volatility, using option prices. There will be practical. I will compare the VIX with itself. Okay, so we will see what's the comparison. Yes.
What's your time period at the bottom?
From 2000. Those are daily data. Yeah, daily data from 2007 until 2010. Those are daily data. I prefer, to be honest, daily data is much better. Monthly data are more for investors than traders, in my opinion. So That's what happens in the crude oil futures market. Let's move on. This is a great thing. I love this. This is the news impact curve.